Hello, ladies and gentlemen, and beautiful people. Thank you for jumping on tonight's call. I'm going to be covering an array of things and also giving kind of a recap of what we did in the last for last week. So, real quick, let's go over to those notes. Just real quick recap. It's important to always know the fundamentals. Number one is journaling your wins and losses. Okay. Number two, trading with a clear mind. Number three, do not risk what you can't lose. Number four, being patient and trusting your analysis will make you become a better independent trader. All right. Number five, do not attempt to predict the market. Number six, count pips, not money. Very important. Number seven, trade your own trading style, right? Your own style of trading is going to come as you mold yourself, right? From when you learn from one person and you learn from another person. And what's going to happen over time is that you're going to develop your own trading style. And it's important to do so because then it makes you feel, one, more confident, and two, it'll make you more consistent. All right. Number eight, using confirmations is important. Do not trade blindly. Number nine, do not chase trades. I'm going to move here, T. Do not chase the trades. And number 10, which is the most important one, withdraw, 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 right? Get used to withdrawing. Even if it's a little bit of money, doesn't have to be that you're withdrawing, 500, 1,000, 2,000, $5,000. If you're even withdrawing $50 a week, it's just to help you get acclimated with withdrawing as a whole. Okay. So very, very important. So today, guys, what we're going to cover today is key levels. And what key levels are very simple. Support and resistance. Some people call it supply and demand. It's all the same thing. It's all just areas of importance, right, that you want to take a look at in the market. We're going to be charting up in just a few, but I want to just have you guys understand what they are, right? What the actual terminology is, right? So what are key levels, right? These levels are important, right? These technical levels are which financial institutions could face an increased buying or selling pressure. Traders look out for these chart levels to place their buys and sells so they can know where the market wants to go to next, right? Which kind of tells you the directional bias of a certain trade, right? Let's say you're looking for buys on the dollar and you're looking for sells on euro or Great Britain pound pairs. You're looking to see where price is at these levels. Okay, they're going to give you price movement and increased volatility when price reaches those levels, meaning that when these zones get hit, you want to start seeing the market giving you erratic behaviors to the opposite side. So if you're looking for an uptrend, right? If you're looking for a trend or a hit off a demand level or support level, then you know it's going to go the opposite way. Let's go over some examples of how to identify these key levels. So let's go to Great Britain pound. And what I'll do here, because this is one of my favorite pairs to trade, let's go ahead and take off all of these markings right here. And we'll see an example of what just happened last night, right? What happened last night was market came down to a key level. But before we do that and go over what happened last night, what you guys need to understand is that when you're doing an analysis of the market, you want to do something called top-down analysis, right? From the top all the way to the bottom-most time frame, right? So write that down. Top-down analysis, meaning that when you're doing an analysis and looking out for these key levels, monthly levels are going to be important. So you want to go over here to the monthly time frame to chart out these key levels, right? And these key levels are what I like to use, guys, right here. You can either use a horizontal ray a horizontal line, or what I like to use is just a rectangle, because I understand that it's not just one little point that it's respecting, it's a zone. It can be it can be a zone that can be 10 meters, 10 meters, 10 pips wide, or even 30 pips wide, and so on and so forth. So these zones can be fairly big. So first and foremost, you want to start from the top down, right? So the most highest price right here is this zone right here. And now you want to continue heading down and identifying these support and resistance levels, right? So you see that this was a resistance, right? Nice little head and shoulders patterns for those that follow head and shoulders patterns right here. Very beautiful, very clear cut, right? So you want to just take all these levels and draw them out all the way. You want to extend them all the way out to the right. Each and every level that gives you a significant bounce, right? All these levels, you want to now draw them all the way to the right. Why? Because now when price reaches these levels again, and you also even want to do this last bottom one right here, when price reaches these levels, you want to now take advantage of what the market might do at these levels. You want to see significant bounce off of these levels. You see how this created a resistance, right? And then became support. But not only do you want to do that on the monthly, you then want to go down to the weekly and then look for more key levels, right? So you can start all the way at the right, right? All the way from the beginning of the chart. Start looking for these levels, right? This was a significant level, and you can use different colors to identify different time frames. That's what I do. So you're not confused. You know that the green is the monthly, maybe a red is the weekly, and then you can go down to the daily and make it a different color. So now you want to start identifying where these levels are in these markets. So you want to just start mapping out these levels. These levels was resistance, came back, became support, broke back down, became resistance, broke back up, became support, broke back down, became resistance. So this is a level that you want to see things happening, and you want to extend that level all the way to the right, okay? And you want to continue doing that for each and every time frame. So now you want to go on the daily, and now the daily you can make yellow, whatever you feel comfortable with, and then identify more zones. So the more zones you identify, the better it is for you to see where the market wants to go next. Again, you're going to see different zones. You're going to see these zones that play out at these different time frames. And it's going to be very important to identify these zones. Now, does this cause a little clutter? Yes, it does. For somebody that is beginning, I would recommend to draw these levels out. As time goes on, you no longer have to draw out these levels because now you're able to kind of see it with your naked eye. But it is important for you to draw out these levels when possible, okay? Whenever possible, draw them out because they're going to be important, right? So now at this level, right, now that we got this, what we call a V bottom down at this level, you want to now see what the market wants to do when it retests this level. Why? Because now on a lower time frame, you see that this level right here that used to be resistance, now it's support, broke through, came back into this area, and then retested this area, not closing below this low. So now you're seeing, okay, this can react now moving away into this area, going above, which is, this is exactly what we were anticipating. This is why we were looking at this for a buy last week and this week, okay? And now you want to see reactions off of this level. So again, guys, you want to go from the top all the way down to the daily. Then you want to do it on the 4-hour. Why? Because each and every level is going to give you significant key levels of resistance and support. As you see, resistance gave you some erratic behavior, came back, gave you another resistance, came back, gave you the same exact thing, which was a price jump out of that area to come back in, gave you the same exact thing, price jump out of that area to come back in, and respect this zone. These zones that get hit are no coincidence. They happen time and time and time again. You just have to know how to identify it, how to draw it out, and how to anticipate and sit on your hands so you can take full advantage of what these markets have to give. If you guys understood that in the chat, please type a 111. If you guys are seeing these levels play out, type a 111 in the chat. I want to know that you guys understand what's going on here in the market. Type 111. Great, great, great. Awesome. Okay, now moving on. Another thing I want you guys to understand is that these levels going horizontally are not the only thing that you need to look out for. Remember that key levels of support and resistance don't only go horizontally. They also go vertically, and these are called trends and channels. And I'm gonna show you exactly how we chart them up as well. A trend is a tendency for price to move in a particular direction over a period of time. Trends can be long-term, short-term, upward, downward, and even sideways. Success with Forex market investments is tied to the investor's ability to identify trends and position themselves for profitable entries in a market, right? So now that you understand what you're looking for, if the market is going up, you are only looking for buys, and if the market is going down, you're only looking for sells. Now you understand that if the market is in a downtrend, you are no longer looking for buys in the market. I see people do this all the time. Oh, this is going to be a buy, but it's a clear downtrend, right? And going back to the first training, if you haven't checked that out, go back into my YouTube series. That's going to be in market structure, that market structure video I did. That's going to allow you to understand trends and channels, right? Market structure. Now let's identify some market structure here, some trend lines here, right? And what you want to do, guys, is whenever you're doing trends, again, you want to identify the trend on the higher time frame. And as you see here, this gave us the high, right? Then it gave us a lower high, right? And what you want to do is you want to plot out these data points, right? These are called data points. And what you want to do is you want to take a trend line right here, trend line, select it, and then you want to go and hit this data point, but continue all the way down. Now, what I consider a trend in the market, guys, is at least 3 touches, right? So for instance, you have a downtrend, and then you also have an uptrend, right? This could have also been the uptrend right here, right? As you see it right here, hit the zone, false break back into the zone, and then final break below, okay? But what identifies a trend, right? So 2 identifies the trend, the 3rd touch confirms it, okay? So here on the monthly, I would want to see a touch of trend. This eventually, guys, is going to do something maybe along these lines, right? Now, is it going to respect and then come back down? It might. Can it move upward, break through the trend, and then retest the trend before coming up? Of course. It's an if-then game. Now, after the trend is confirmed on your third touch, you usually do not, not that it's going to, not, usually what ends up happening is that you usually, once you get your fourth, fifth, and even sixth touch to that trend line, you normally have a weekend trend line. The way I explain it is if you hit a piece of wood, right, with a hammer, and you keep on hammering that piece of wood, eventually the piece of wood is going to become weak enough to break. And it's the same exact concept that we have. Now, when drawing a trend line, you want to make sure that you're drawing it from above, okay? So from the top of price. Now, let's go to an example of an uptrend here with with GU. Let's go at an example of an uptrend here on the daily time frame, since it's not many on the higher time frame, right? So you want to start at the low, right? At a low, and then you want to continue upward. Okay, you see that is a trend. Now you want to count the amount of touches to this line. So 2 confirms it. What are you doing on the third one? You're being patient, because the third hit is usually your money maker. Usually anytime I see the second hit to a trend line, if I see the third one, I'm usually looking for buys or sell scenarios, depending if I see an uptrend or a downtrend. But obviously this is going to correlate with all my other confirmations. So don't just use a trend line as a way to get into a trade. That would be horrible, and you would definitely lose a lot of money. Okay? So don't take trends as something that solidifies a trade for you to take. Take it as a confirmation, as one of the things you're looking for to get into the trend, into a trade. So here you see that third touch. You could have even took this fourth touch, and guess what happens? What happened on the fifth touch, guys? What happened on the fifth touch? Market came up, right? Gave you the last of this trend and destroyed the trend. Destroyed it, right? Now you have a break in structure, right? This is an uptrend, which creates structure, as you see, and then broke below to break structure, okay? You also have this M pattern. Yup, you also have this M pattern that was created that gave it enough momentum to break through. All right, guys. So identifying these trends are going to be very important. You can also do something called inner trends, something along these lines right here, something like this, where you can also take a trend line and it can make an inner trend where you also have the same exact touches to these zones. You see, one touch, second touch, third touch gave you a good trade. Now, the third touch is where I normally want to take a trade, but again, it also has to give me my other confirmations. Remember, guys, I use 6 confirmations in order to get into the trade. It has to give me 6 confirmations. Now, look what it did on the fourth touch, right? Market came down, broke above, retested, and then broke above, giving you this nice bullish momentum here to the upside once it broke out of this zone. Now, what you call this right here, this intersection, right? This intersection is when price gets trapped. This is called price trapping, when you have a downtrend meet with an uptrend, right? A downtrend meet with an uptrend, and you usually get price want to break either above or below to continue, or break above to retest. So you want to see the initial move and then catch the retest on the way back down for a breakout. So a price trap is usually going to give you a good indication of where price wants to break out to, and then you can get into the trade on a retest. Remember, guys, being patient pays. So wait for a retest before getting into the market. Okay, guys. Now, let's go back to our notes. Now, we're also looking for channels. Channels are just about the same thing, but it's a bit different. A channel is when trading in a range bounds from a trend line and a concurrent line. And I'm going to draw that out for you guys in a bit. In a concurrent line plotted through the opposite peaks or roughs through these three types of channels, depending on price direction. It's going to either give you an ascending channel, a descending channel, or a sideways channel, which we call consolidation. All right. But this is also called trading in a range, right? And I went over that in my first webinar. You guys can recheck that out on there. But one thing I want you guys to see is how these channels get created, and you're able to trade within that zone. Because remember, guys, you're either moving up, down, or sideways in the market, one or another, right? It's either you're consolidating for a good amount of time, you're moving really strongly to the upside, or you're moving very strongly to the downside, one or another, right? So real quick, I want to just go ahead and go over a nice example of a nice trend channel that you can have taken advantage of, right? And we'll do this uptrend right here, because I really like this uptrend as an example, right? If you're drawing a parallel channel, you're going to draw your trend line just like normal. You're going to draw it right here in this range, and then you're going to move it up. Okay, you're going to move it up to where price now starts respecting even on the upside. So if this is trading in this channel, are you not going to be more prone to take sells up here and take the buys down there? You can actually get into some counter trend trades when the market comes up to these areas. I have a pretty nice trick with Fibonacci when it comes to trends, and I'll go over that when I go over Fibonacci with everybody. But one of the ways that I can find out where the market is at within a trend, and I'm going to do this kind of explaining how we can take advantage. So I would take the bottom, right? I would draw my fib from the bottom to the top of the trend, and I would do the same on the opposite side. And I'm going to show you something real quick. Something I really never really showed anybody, because this was taught to me by my mentor back when I first started learning, right? So I take these trends, right? I take these trends and I draw Fibonacci from one side to the other. And it's not measuring out any specific thing. What I want to know is how much area is in this trend. And what I take is I take a trend line and I go on all my Fibonacci levels and I extend it, and I match them up with the other Fibonacci on the other side. And what this does for me, guys, is that this gives me an idea of where I'm at. Am I at the 50? Am I at the 7-9? Am I where am I at? And I'm gonna show you why I'm drawing out these zones. These zones are important, guys, because it's important to remember whenever you're in a consolidating market, whether it's just trading in a range or trading up or trading down. Let me show you something. The market always stays in the middle most of the time. 70 to 80% of the time, market is never in these zones. And I'm going to draw it out for you so you can see what I'm talking about. And it's important to know when you're in these zones, right? So take this zone, for example, right here. And let me make this more darker. Boom, right there. And then let me get another trend line, and we'll do it from here to there. And the reason I do it is because This is the other zone. Now, guys, do you see that the market most of the time is going to trade within this middle zone right here? And when it finally hits the outer areas, you finally are seeing the reaction that you guys want to see. It's no coincidence that the market, when trading in the middle, is going to give you no trading opportunities. It gives you the opportunities when you're finally within these dark zones. So if you draw out this trend line, unless it breaks through completely, you are looking for these trends to get respected, these channels to get respected. For the most part, they will, unless you get something like this, which is this is kind of like a fake out breakout, and then trades right back into the channel, right? Fake out, breakout, trades back into the channel, gives you this double top right here. Since we've and I'll show you guys exactly what that is right now, right? Right, gives us a double top formation, this M formation right here, giving us this double top. And let me go ahead and draw that out for you guys. All right, so it gives us that double top, 1, 2, right, and then finally gave us that big M, right? Didn't give us a big retracement, but the market doesn't have to all the time. The market doesn't always have to retrace where you want it to, because you're looking at previous structure. If you were already looking at previous structure, then you saw that this was a significant uh, um, area where it bounced off, came back in, and then bounced off again for a head and shoulders pattern off of this zone. Okay, but now again, how many confirmations gave us the break of the trend, gave us a head and shoulders, gave us an M, right? I mean, if I did more analysis, I'd probably see other things like divergence and things like that. But again, guys, I am not taking the trade unless I have these confirmations. Now, guys, I want you guys to practice this, right? I want you guys to practice this because it's important to understand these fundamental ideas that are going to take your trading to the next level. Now, again, learning this is going to set up that foundation for you to be able to take advantage of what the market has to give. Guys, that's my time for today. I want to thank everybody that got on this call. If you guys have any questions for me, send them through the chats. Text me if you have my number. Guys, it's been more than a pleasure to serve you guys. Next time, we're going to be covering some more strategies, some more maybe indicators and things like that that you can use to your trading advantage. But guys, thank you. I'm forever grateful. And take care and stay tuned for the next series that we'll have in the next coming days.